we're venturing into the fascinating world of technical analysis, specifically focusing on cryptogaps. You've seen them on your charts, those intriguing spaces that suddenly appear between candlesticks. But what do they mean? How can they influence your trading decisions? In this 10-minute crash course, we'll demystify these cryptogaps, decoding their secret messages. So, buckle up, and let's unravel the mysteries behind these gaps on your charts. Cryptogaps are like secret messages on your charts, whispering tales of market dynamics that might otherwise go unnoticed. These gaps occur when there's a stark difference between the closing price of one candlestick and the opening price of the next. It's as if the market takes a breath, and in that suspended moment, a gap is born. These gaps are not random occurrences or glitches in the matrix. Instead, they are a manifestation of the forces of supply and demand dancing in the vast arena of the cryptocurrency market. They are the echoes of the collective decisions of thousands of traders worldwide, each one acting based on their knowledge, intuition, and yes, sometimes their fears and hopes. Cryptogaps are significant because they provide insights into the market sentiment. They are like footprints in the sand, showing us where the market has been and hinting at where it might be heading. A gap can indicate a sudden surge in interest or a swift retreat, a moment of consensus or a divergence of opinion among traders. In essence, cryptogaps are tools for discerning the heartbeat of the market, the rhythm of its rises and falls. They help us make sense of the market's momentum and volatility, two crucial aspects of cryptocurrency trading. But what do they tell us? Well, that's a story for the next scene. So stay tuned as we delve deeper into the world of cryptogaps. Opening. Not all gaps are equal. Now let's delve into the diverse world of cryptogaps. Just like snowflakes, no two cryptogaps are the same. They come in all shapes and sizes, each with its unique story to tell. To make sense of these stories, it's essential to understand the different types of cryptogaps. First up, we have the common gaps. Now don't let the name fool you, there's nothing ordinary about these gaps. They typically occur within the boundaries of a price range and are often the result of regular fluctuations in trading activity. These gaps might seem insignificant at first glance, but they are a crucial part of the ebb and flow of the crypto market. Next, we have breakaway gaps. These are the drama queens of the gap world. They occur when a cryptocurrency breaks out of a trading range or pattern, often accompanied by a surge in trading volume. Breakaway gaps can signal the start of a new trend, making them a beacon for trend-following traders. Then, there are runaway or continuation gaps. These gaps are like the second act of a thrilling drama. They occur in the middle of a price trend and can indicate that the current trend is about to get a boost. If you're riding a trend, these gaps can be your cue to buckle up for a potentially exciting ride. Last but not least, we have exhaustion gaps. These gaps are the closing act of the trend. They occur near the end of a price trend and can signal that a trend is running out of steam. It's like the market's way of saying, the show is over, folks. So, whether it's a common, breakaway, continuation, or exhaustion gap, each type of gap offers valuable insights into market dynamics. The key is to understand what each gap is saying and how it ties into the broader market narrative. Closing. Let's understand the nuances. As we dive deeper into the world of crypto trading, remember that understanding these nuances is what sets successful traders apart. So, keep an eye out for these gaps on your charts. Happy trading! Gaps don't appear out of thin air. Now that's something worth remembering. So what causes these crypto gaps we've been talking about? Let's delve into the common causes, including news events, market sentiment, and trading activity. First up, news events. Cryptocurrency markets are highly sensitive to news. An announcement of a new partnership, regulatory changes, or even rumors can cause significant price movements. If this news breaks when trading is closed, it could lead to a gap when trading resumes. Next, we have market sentiment. The collective mood of traders, influenced by a myriad of factors, can also cause price gaps. For instance, if traders are overly bullish, they might start buying at higher prices, leading to an upward gap. Conversely, if traders are bearish, they might start selling at lower prices, causing a downward gap. Lastly, let's talk about trading activity. The level of trading activity can also cause gaps. Remember, cryptocurrencies are traded 24/7. However, trading volume can vary significantly depending on the time of day. Lower trading volumes can make the market more susceptible to price manipulation, which can in turn lead to gaps. While these are the most common causes, it's important to note that gaps can also occur due to other factors. These include technical glitches, liquidity issues, or even large trades by whales. Those are the big players in the crypto market. Understanding the causes of crypto gaps is essential for any trader. They can provide valuable insights into market dynamics and potential future price movements. However, it's crucial to remember that gaps are just one part of the puzzle. They should be used in conjunction with other technical analysis tools and indicators for a comprehensive trading strategy. So now that we know what causes crypto gaps, we're one step closer to understanding how to leverage them in our trading strategies. But remember, always trade with caution and never invest more than you can afford to lose. Let's uncover the causes. As we continue to demystify crypto gaps, stay tuned for our next scene where we'll discuss how to interpret these gaps in your trading strategy. Now let's make it practical. Can you interpret the cryptic language of crypto gaps? Let's find out. Imagine you're scanning your trading chart, and you notice a gap. What's your first move? You need to identify the type of gap. Is it a common gap, appearing due to routine fluctuations, or is it a breakaway gap, signaling a potential trend shift? Your trading strategy will largely depend on this identification. Now, let's say you've spotted a breakaway gap. This could be a significant sign that the market is about to change directions. It could mean that a new bullish or bearish trend is forming. However, remember that not all breakaway gaps lead to new trends. Sometimes they're false signals, so it's essential to cross-verify with other technical indicators. On the other hand, if you've identified a common gap, it's generally not cause for immediate action. These gaps often get filled as the market continues its usual ebb and flow. But don't dismiss them entirely, as they can still provide valuable insights into short-term market movements. Another crucial aspect of interpreting gaps is understanding their size. Larger gaps are typically more significant than smaller ones. They indicate stronger market sentiment and are less likely to be filled quickly. But what if you see multiple gaps in a short period? This could be a sign of a trend exhaustion. It's like the market is taking a breath before it decides its next move. These are called exhaustion gaps, and are often followed by a reversal in trend. Remember, gaps are like puzzle pieces. They provide valuable clues but should not be used in isolation. Always consider them as part of your broader trading strategy, along with other technical analysis tools. So, there you have it. Interpreting gaps is a skill that can give you a competitive edge in the dynamic world of cryptocurrency trading. They can be your early warning system, your trend identifiers, and sometimes your profit makers. We'll look at examples and discuss how gaps can be valuable indicators for traders. Time for action. We've understood what crypto gaps are, their types, causes, and how to interpret them. Now, it's time to put that knowledge into action and discuss trading strategies that leverage these price gaps. Firstly, we have the gap filling strategy. It operates on the principle that price gaps tend to get filled. In simpler terms, the price often retraces to the original level before the gap occurred. So savvy traders can potentially profit from these movements. Next, let's talk about breakaway gap trading. Remember when we discussed breakaway gaps? They signal a strong movement in the direction of the gap. Traders can leverage this by entering a trade in the gap's direction, anticipating a continuation of the trend. Another strategy is exhaustion gap trading. These gaps occur at the end of a price trend and signal a final push before prices start to fizzle out. Traders can use this as a sign to exit their positions and lock in profits before the trend reverses. Lastly, we have the continuation gap strategy. These gaps often occur in the middle of a price trend and signal that the current trend is likely to continue. Traders can use this as an opportunity to enter or add to their positions. Remember, no strategy is foolproof, and each comes with its own set of risks. However, with careful analysis, disciplined execution, and risk management, these gap strategies can add a powerful tool to your trading arsenal. Discover how you can use gaps to your advantage. But wait, with great power comes great responsibility. While gaps offer insightful data, they also carry inherent risks. Market volatility can make gaps unpredictable, and not all gaps get filled. Remember, gaps are just one piece of the larger puzzle. They should be used in conjunction with other indicators to make informed trading decisions, and always consider your risk tolerance. Because in the world of crypto trading, the only sure thing is uncertainty. Let's discuss the risks and considerations when incorporating gaps into your trading decisions. As we conclude this crash course on crypto gaps, it's clear that these silent indicators can be a trader's best friend. We've decoded what gaps are, their types, causes, and how to interpret them in trading. We've also laid out some strategies and risks. If you found this guide valuable, don't forget to like, share, and subscribe for more insights.